macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Is it still too early for the big stock market correction? I think it is. But let me show you how I handled it and sort of fumbled the ball in the past 2 weeks and what we're going to do about it now. Let's go to, first I want to show you my market map from early January. On January 5th, I gave this to my Market Timer subscribers. This is our standard scenarios and probabilities map where I look at important price levels and potential ranges and the probability of trading within them. So I was very bullish, and on that next pop up to 1850, I saw still a 30% chance of a breakout. But the high probability scenario obviously would be the range trade, bumping up against resistance at 1850. So this is really the base case since it's a 50% chance. And I saw 1780 as being good support for the S&P, with obviously an 80% chance of staying above it. What I did wrong though was on that next move back up to 1850, I really thought that the bulls were going to take it higher. And in an environment like that, when you're just drifting sideways, all it takes is a tiny little catalyst like Argentina, Turkey, and the rest of the emerging markets falling apart, or a sub 50 PMI print from China, and we end up taking 4% off the top. All right, back to my map. Really the way I should have played this was being cautiously long at 1850, waiting for the confirmation above, and then getting ready to get very long, in the 1800 area. The interesting thing about this 1780 level, I chose it because I wanted to be just above 1775. 1775 was important because in October and November, for 2 weeks, 1775 was a lid on the market. Kept trying to get through there, and then once we did, in December, 1775 became support. So that's why 1775 was an important level, Ocnov tops, and then support in Dece. And so I picked 17. If we hold 1780, that was important to me. One last look at the map. So, really I needed to be a little looser with my range here and look at 7080. And, I was looking for a crack down through 1775. We didn't get it. In the beginning of the month, I only had a 15% chance of that happening, and it looked like it was going to happen yesterday, Wednesday, after the FOMC, and here we are bouncing back up to 1790. I've made a new map for market timers for going into February. And it's a little different than this one. If you want to give it a try, and you can see the map easily just by signing up for a free trial. Now I want to show you 3 charts for the market let's go back to breadth. All right. So let's look at the percentage of stocks above the 200-day moving average. A lot of stuff going on here. You'll notice that in early last year, we got this divergence, right? The percentage of stocks above their 200-day moving average is sloping down, while the black line is the S&P 500 is rising. This is actually not a divergence where you'd want to be short. What's going on here is that when a market turns and bottoms like it did in late 2012, you end up with a massive amount of stocks above their 200-day moving average. Why? Because the 200-day moving average was sloping, maybe trending down, and all of a sudden these stocks get above. So now everybody's above their 200-day moving average. So that's why you see, this look here in May, nearly 95% of stocks in the S&P 500 were above their 200-day moving average. So this needs to work off anyway. But what I was watching was this 75 level here, and if it would lead to corrective action like we had the 2012 correction in June. And then again, the weak action off of September and November in 2012. Because this is all about breadth, right? And you can look at this for the New York Stock Exchange stocks too. On stock charts, just use NYA as your symbol, and you can look at breadth that way too. Obviously, a much wider base. You're talking over 2,000 stocks. So all the breadth indicators that I look at, you can either look at them on the S&P, which is easy, or the NYA. All right, now what else is going on here? this, 50%, obviously when 50% of stocks get below their 200-day moving average, I'm a big buyer down there in a bull market. And even below 65%, and this is really where I thought we were going. A dip down below 1750 on the S&P, and sort of a washout cleansing, not a full 10% correction. I was looking for about 5 to 8%, and then we'd go higher. And that may still happen. We may not get back above the 50-day moving average on the S&P, and stay below 1810. If I had a 3-year chart here, you would see that the real washout, like 2011, you get 10 or 20% of their stocks above the 200-day moving average. All right, I think that's all I wanted to show you here. Let's take a look now at the bullish percent index. Remember, bullish percent index is the number of stocks in an index on a point and figure buy signal. We looked at it last week. I said I was watching the 75% level to see if a new trend was developing of stocks on a, moving from a buy signal to a sell signal. So here we are again. I drew the green line because the stock charts doesn't seem to be updating properly. And here's the black, the S&P behind it. So what do? We took out the 75% level in the past week, have come down to 70. Now this is end of day as of Wednesday. Actually, no, this is real time. This is not end of day data. So this is one of your breadth indicators that is real time on stock charts, and we're at 70%. So I'm still a little cautious here. We want to see which way this thing goes, and if the S&P still rises here and we go up to 1800 or 1810, but the bullish percent index is still fighting to stay above 70, then I think we're due for some more corrective action. All right, next let's talk about, the easy way to look at breadth, as I said last week, is what are the growth indexes doing? The NASDAQ and the Russell 2000. NASDAQ full of, tech stocks and biotech. Russell full of financials, and that's one thing that people miss why the Russell did so well in 2013. It had a lot of small cap financials, but also, it's about growth, and it's about our fundamental economic conditions improving. You're going to see small caps, still with a bid because portfolio managers are heads down picking stocks there. Now, so let's be clear about any corrective action here. I'm not looking for a big 10 to 12% correction, even though it might be good for the market to wash out weak hands. Nothing has changed about the fundamentals. I'm not that concerned about emerging markets, and on the home front here, we've got still low interest rates and an improving economy and earnings growth. So nothing fundamentally has changed, and that's why I'm going to use my canary in the coal mine. I'm going to use the Russell for that. So here's the Russell 2000. Below its 50-day moving average, not a big deal. I'm really looking at the 1150 level. If the Russell gets above 1150, then I think it's pedal to the metal, and we're going to make those new highs into S&P 1900 here in the first half. So that's the one I'm watching. Now, speaking of growth stocks, I just want to show you the FTM Trader, follow the money, where we track institutional buying in growth stocks. We had a great 2013. I'm just going to show you some of the numbers here. We bested the S&P by double, 66% versus 32%. And we're off to a great start in 2014. Tracking a total return right now of 81%. That's going to fluctuate 2 or 3% a day. But, I don't think that 2014 is going to look like 2013 here. But, we're still heads down picking stocks ourselves. And we did that on the back of a lot of biotech. I don't even think we ever lost money in a biotech stock because we're careful about picking them and riding, solid ones that have a good risk-reward opportunity. But a lot of other great opportunities in small and mid caps. Now, FTM is not just small caps; it's also mid caps. I've even had some large caps in there, like VRX, Valiant Pharmaceuticals. So, again, keep an eye on the growth stocks that are on your watch list. I would say keep a list of 25 strong stocks, whether you're actively invested in trading in them or not, and they'll tell you what the market is doing. And that's how FTM has allowed us to stay bullish, because we see stocks being accumulated and we see their growth prospects in an improving economy. All right, that's another look at breadth and what's going on in the market. No big 10% correction on the way, even though I was really hoping for a dip down below S&P 1750. We may still get that. Keep your eye on the Russell 2000, getting back above 1150 as a sign for new highs in the broad market, maybe even this quarter. All right, Kevin Cook, thanks for joining me in the kitchen.